Travis, markets have been eventful over the past couple weeks, to say the least.
Yeah.
We had a period of relatively low volatility here for a while, but fears that the Fed may have held rates higher for too long is provoking these recession fears. And it's driven some steep sell-offs here in the equity markets recently, hasn't it?
Yeah, that's true, Steve. Let's look at the data. Let's start with inflation. Recent data suggests that inflation is moderating, and the labor market is cooling, which is what the Fed wanted.
That's right.
And it's obviously the result of their policy working its way through the system. The challenge now for the Fed is cutting rates in a way that lessens how restrictive policy is without crossing over into stimulative territory. Because if they do that, you could reignite inflation, and we'd be right back where we started. So this is a tricky.
It becomes very problematic.
Yeah, this is a tricky task that they have in front of them here.
Yeah, and due to the recession fears, markets, according to the Fed funds future,
here we go,
100% sure of a rate cut. And at the September meeting,
right.
Which just a few episodes ago we were saying that was only 77%.
Right.
So, or not we, but the futures were. In every FOMC meeting since 2009, the Fed has done precisely what the markets have expected.
Yeah, so the 100% is
probably pretty likely.
Yeah.
Throughout the sell-off in equities, rates started moving lower, aligning with Fed cut expectations.
Mm-hmm.
Falling rates lead to higher bond prices, obviously, and throughout this volatility, bonds once again now are acting like a hedge. It's diversification at work or at its best, isn't it, Travis?
Yeah, it is, and it's also a testament to starting with higher bond yields is a better place than we were, just a few years ago with extremely low yields. But speaking of diversification, Steve, we've previously discussed what we call top-heavy markets here. Returns for indexes such as the S&P 500 and even more for the NASDAQ have been concentrated in a handful of stocks.
Yeah.
Driven by the vast expectations for artificial intelligent growth of these particular companies, and the narrower markets become, the more fragile they can become, and we've experienced some of that here with the most recent drawdown or sell-off. You've seen those top names pull down, and it's pulled down those indices with them. And I think it's even further evidence of why exploring opportunities beyond standard indices to gain exposure to other unloved or untapped areas of the market makes complete sense. And again, that's diversification at work, to look outside of those standard indexes.
That's right. And bottom line here, Travis, is the volatility in equity markets are very normal, and we really need it to be expected.
Right.
The median, so get this, the median intra-year drawdown for the S&P 500, this goes back to 1928, is around a negative 13%.
Right.
So that's what people should expect, right?
Right. At least, once a year, you should expect, if you're owning stocks, you should expect that type of drawdown.
Absolutely.
But I'd even go a little further here, Steve, and I'd say that market volatility is actually a feature of the market. It's not a bug.
Yeah.
Suffering through that volatility is actually the price of admission to access, the equity market's long-term favorable returns over time. Because without that volatility, without that risk, equity markets wouldn't offer any more reward than sitting in cash.
That's exactly right.
Again, the price of admission.
It's right. You just have to be patient, right? And
patience is probably the number one virtue when investing. So.
Yeah, it is. Travis, this has been great. I look forward to it next week.
Look forward to it as well.